Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only financial planner. Today I want to take you through what investment planning looks like with a client. While I cannot provide an entire picture of this process, I can at least show you how we approach the process from the beginning and what the client may see once we're presenting the plan. In just a moment, what you'll see is a mock client, and then I will discuss how we approach their investment strategy. We will dig into their investment portfolio compared to one of our standard portfolios. Again, it's not the entire process, but it gives you a look at how the conversation goes when addressing investment planning and what you can expect to see from the process. Not shown is all the steps we take to ensure the investment portfolio is adopted and managed once the client agrees to move forward. Let's begin. So as we run through an example, first we need to figure out who we are helping because so much of the advice is going to depend on the individual or family group. And so for this example, I've just created a typical person who may come through the door. So you have someone who's 45 and they're a private practice therapist. They are married to someone who is 43 and that person works for an organization, and they have two children. One is 13 and one is 8. And so from there, we would take a look at the income coming in. And so the spouse who works for an employee makes $80,000 a year, and the person who's runs the private practice makes about $150,000 a year. They currently spend about $8,000 a month. In terms of savings, they have the private practice therapist has a solo 401k that they put about $2,000 in. The spouse puts about 10%. They have a pretty traditional match of up to 3%, and then they put $3,000 into an IRA. And then you also have from 529 savings. They contribute $1,000 to each child's college education. Now for their goals, they want to retire by 67. They want retirement expenses to stay at their current levels, inflationarily adjusted for inflation. We've added health costs, long-term care costs. They also have, they would like to pay for at least some of the child's education, and the private practice practitioner, has been doing pretty well, wants to get a $50,000 car in the next year or so, and then they go on a family vacation of about $3,000 per year. The only other thing is in the net worth, we would include any bank accounts, joint and personal, any credit card debt, any other debts, the investments, as well as any loans that are out, whether it's a mortgage, another business loan, maybe the current price of property, and any other sources of income. One thing we find when people are first meeting is that they are most concerned with their investments, what they're doing right, what they're doing wrong. They believe this is the thing that's going to set them on the right path. And it's one of the things. It's very important, don't get me wrong, but it's often the first thing we have to focus on because of the emphasis that someone has on it. But it's also one of those things when we first work with a client that we may take the most work on in the initial meeting, but it's also one of the things that once we've set it in the right motion, it often takes care of itself in a lot of ways outside of rebalancing and kind of adjusting based on the age and the goals that may change over time. But nonetheless, in the initial stage, it's a very important thing to get right. And so what we will take a look at in this sort of example that I put together of this private practice practitioner, in terms of the investments, what was doing right, what was doing wrong. And it's key. It's a key part of the process to make sure that we get this number as close to 100% as possible. Initially it was 36%, somewhere around that. Now it's 96%. That's a huge boost, and a large part of that boost comes from the investment plan. So let's see what we did for them. Now, in the scenario, is very difficult to just mimic. But what we often find are people, um, have many different individual stocks or a large, grouping of the company that they work for, stock and things of that nature. But in this situation, just for ease sakes, just for this presentation, what we've done is put their current portfolio in 50% stocks and 50% bonds. And that's what this shows. So as you can see, 50% bonds, 50% stocks, an annual return expected around 8%, and a standard deviation, or how much it moves up and down, about 9.4%. But the problem was this allocation not only wouldn't work because of their goals in terms of when they want to retire, or what they need in retirement, that sort of thing. But it's actually one thing we will do when we work with someone new is take them through a risk tolerance questionnaire, and we get a sense of how comfortable they are with risk. What's going to happen if the stock market falls? Are they going to sell? Are they going to do something that they shouldn't be doing, just out of fear? And it turns out, this couple doesn't really have those concerns. They are fairly risky. They don't mind putting a little bit of risk, and frankly, they have a long time to invest. So having a little bit of risk, a little more in equity, it's a smart move over the long term. And so in our scenario, what we've done is show them what a growth allocation would look like. So instead of 50% equities, we're actually at 43%. Instead of 0% international, we're at 17.9. Emerging markets, we've added some. Real estate, we've added some. We've reduced the bond size because for someone in their early to mid 40s, that's a lot of bond exposure. When you have a long time, 20, 30, 40 years to let any sort of ups and downs in the equity markets to right themselves and see returns. And then international bonds, we've added some, and a little bit of cash. And so as you can see from this, we have increased our annual return expectations to 8.8%. We expect a little bit more risk involved, and that's what the 11.7% shows. But over time, that risk tends to even out, and that's when we see the returns. So when working with someone, we would not only show them, how our, some model portfolios would perform against what they're currently doing, we'd also show them exactly how they can adjust their portfolio in order to match a more optimal portfolio like this growth portfolio. And so can't really show this to you right now, but essentially what we would be doing is going step by step within an Excel sheet, whatever, and showing what needs to be sold and what needs to be bought. Whether we're doing that, whether they're doing that themselves, we would show a step-by-step process to exactly what needs to be sold and what needs to be bought in order to bring that into alignment. During this call, we would also be showing sort of the differences in asset allocation, as kind of walked through a little bit already. We would also be showing the tax allocation. In this case, they only had a 401k and an IRA, so it's all tax deferred, very similarly. So there's not much tax allocation involved. But part of the planning process would be looking at seeing whether we can incorporate some taxable assets into the portfolio, because that'll help down the line when you're ready to distribute those funds in retirement. And it's all to ensure that you're keeping the most possible and the least amount is going to Uncle Sam. So it's a very helpful step in the process. And then that is that. And so from there, as long as the what we've shown matches the goals of the client and the client feels comfortable with that, then we would either go about making the changes to the portfolio, or we would help them make the changes to the portfolio under a subscription plan.